Welcome to the latest edition of Fundamentals. This time around I'm going to look at one of the so-called passive funds that sits within our new list of 72 favourite funds, namely iShares Core MSCI Emerging Markets IMI. Now this is an exchange traded fund or ETF. It's designed to track the performance of the underlying assets and deliver that performance minus its running costs. In this case, the ETF is tracking an index which has got the very specific name of MSCI Emerging Markets Investable Market Index. That's what the IMI in the name means. The benchmark covers large, mid and small cap companies across 23 countries, and the tracker covers just over 1,900 of the near 2,600 firms within the index, and it targets stocks and markets which are liquid and investable and whose performance is easy to replicate. This ETF uses physical or direct replication to generate performance, so it owns the underlying securities, around 1,900 of them. The top 5 holdings as I sit here are Chinese internet phenomenon Tencent, Korean tech giant Samsung Electronics, Taiwanese silicon chip maker TSMC, Alibaba, another Chinese internet player, and South African internet and media group Naspers. By country, China is the largest exposure at 26.7% of the portfolio, followed by Korea, Taiwan, India and South Africa. They come to around 70% of the assets between them, as we can see here. By sector, as you've probably already guessed, technology is the biggest weighting at just under a quarter of the assets, followed by financial services and consumer discretionary. Utilities, healthcare and telecoms are the 3 smallest sector positions, so the underlying portfolio is probably better suited to growth-oriented investors rather than those looking for yield or defensive steady stocks. The tracker comes with an ongoing charge figure of just 0.25% a year, so it's pretty cost effective. According to data from Morningstar, only 2 trackers out of a comparable field of 47 are cheaper. The iShares product has around £4.7 billion in assets under administration, so it should be pretty liquid, at least under normal market conditions. And this particular instrument comes with accumulation units, so any investor buying it will have any dividend payments automatically reinvested for them. This also, by the way, is the dollar-priced option. I think you can also buy a version that comes in pounds. The tracker is just over 3 years old and comes with a 3-star ranking from Morningstar for those who place importance in such things. So, those are the mechanics. The question is, why would an investor consider this ETF for their portfolio inclusion today? Well, I think there are 3 factors to consider. First, some of you may fancy looking beyond the UK, given the uncertainty over Brexit, the volatile political situation and the sluggish economic growth which the UK is really having to work very hard to shake off. Second, emerging markets are doing well. They were out of fashion for a big part at the start of this decade, but have roared back in the last 12 to 18 months. A lot of emerging market nations have less debt than we have in the West, economic growth is quicker than we're generating here, and companies are becoming more shareholder aware. This chart here shows how the MSCI Emerging Market Equity Index has beaten its G7 and Frontier equivalents over the past year in sterling terms. Third, emerging markets can offer exposure to sectors which are harder to access via the UK and some other Western markets. If you like the growth potential offered by internet and tech stocks, then emerging markets may be a better option than the UK or Europe, for example. Now, this is not to say this ETF will necessarily suit everyone, as there are at least 3 clear risks. First, as already flagged, this is not a product that's likely to appeal to income seekers or risk-averse investors. Remember, the old joke is that emerging markets are called emerging markets because they're very difficult to emerge from when something goes wrong. Second, having primed its economy with fiscal and monetary stimulus last year, China is currently tightening policy, so its own property market and economy don't boil over. Any big slowdown in China could be potentially a problem for a quarter of the underlying stocks tracked by this ETF. And third, tech stocks worldwide have been flavour of the month for some time. As a result, the valuations attached to some internet stocks are really pretty racy, and there's little margin for error if anything goes wrong. Note how some of the big US names have wobbled just a little bit of late, those companies that we all know who are in the NASDAQ composite. In summary, please do your research before you put any capital at risk, and only you alone can judge whether you think iShares Core MSCI Emerging Markets IMI ETF ultimately fits with your overall strategy, target returns, time horizon, and appetite for risk. Thank you for watching, and I look forward to seeing you next time.